Hello and welcome to the Closing Beat, everybody. Happy Tuesday. How you doing? It's good. We were just talking about movies back here, and I was saying that there's a big hole that has to do with a hole in the Shawshank Redemption, which is when he breaks out through that hole, how does he get the poster back so nice and perfect that when what's the guy, the judge or the warden throws the rock, it snaps through it like it's so taut. How did he do it?
Questions about it?
That's the hole, because it's the poster of the girl and he throws it through and then they look through the hole and it's like, okay, well, how'd that happen? That took me 20 plus times of watching that movie to go, wait a minute. Somebody had to have stuck that back up there and did it.
After a quick Google search, I don't think I've seen Shawshank Redemption, so I'm out on this one.
What are you doing? And that stemmed from a Family Guy clip that I saw where Peter was interviewing the cast of Shawshank Redemption, and he's like, in fact, in the movie, when there was a tape thing there, I'm like, yeah, I was asking that question like years ago. How did he do it? There you go. That's the one movie I've seen every single time it's on. I don't know why I just get sucked into it and I watch it. Yeah, Kevin's the movie buff, so he'll figure it out. Hey, by the way, welcome to the Closing Beat. We're financial advisors, not movie critics, but we were just having a conversation here because we're all nice and relaxed. Cody, you're not on the screen there, so we'll just cut away from that, but your mic is on. Do you feel relaxed over there, mister?
I feel pretty relaxed. I know
yeah, can you see it on my face? Just like,
I like that everybody in the office got massages.
Everybody.
Somehow I had a 30-minute stretch, but yeah, it was good.
We had an office health day. Actually, it's going on right now. Doug's in there. And getting massages. Everybody got massages, and it just works the right spots. But anyways, I will move on from that because we're here to talk about the markets, your dough, how to keep it straight, and focus on all that while other advisors are playing chess or checkers. We're playing chess. What? Did I use that already? No. Today actually worked on a client where we got their effective tax rate down to next to nothing for the year, and they needed money to buy an object. I won't say what it is. They needed money. And so we said, well, look, now you can take a 401k loan and pay yourself back the interest, which was 9.5%, but you get to keep all of that and you're not actually paying tax on the dollars you put back in there. So ta-da. So we worked that out over the next couple of years. Pretty cool. If you like that stuff, check us out. Anyways, the S&P here today was down. You probably saw Moody's downgrade. What was that, like eight, 9 banks, something like that. There was one that wasn't actually a downgrade for them, but they kind of lumped it in there. I'm not sure what happened there. And so nonetheless, this morning here you had regional banks selling off, although closed near their open, so not too bad of a day for them. You had financials do the same. So what initially pulled the markets down, it sort of helped, right? They rallied off their lows and it sort of helped things out. If you look at the S&P, you're seeing the same thing here, right? So all the way down, and just that recovery off of the lows really helped for today. Now, it was one of those risk-off type days. You ever hear them say that? Like, that's a risk-on day, risk-off day. Well, when they say risk-off, what does that mean? If you think about it, financials being down today, well, that's a cyclical sector. Okay, so when you want to take risk and you believe the economy is getting stronger, you would do that. Materials would be another one. That's a cyclical sector. These two sectors, in this example, they lagged behind the defensive sectors, which would be healthcare. Great day, right? We just talked about healthcare the other day and why that was going to get stronger. Utilities, all right, not very strong overall, but that's a nice day, right? It beat the other two sectors. And so what we have is, that's one way to see it's a risk-off type of a day, where we want defensive stuff. We don't want to be risky, and that's kind of the mood that was around the market. Now, one other way you can look at that is you could look at short-term bonds. In particular, you could look at the 10-year. And if you look at the 10-year, that fell today, meaning the yield fell. Prices finally went up a little bit. We haven't seen that in a while. But the yield fell. Right? So when interest rates go down a little bit, that's because people are buying bonds. They want to take their money. They don't want to risk it in the stock market. They want to buy bonds. So that causes yields to go down and the prices of bonds to go up. That's another indication of sort of a risk-off day today. Now, part of it could have been due to UPS. We'll cover that here in just a little bit. That had an interesting earnings report. We'll dive a little deeper into that one. But I do want to point out that so far, this earnings season, the performance that's wrapped around earnings seasons there, when you look at the results of what people have reported so far, and we're more than halfway through earnings season, the beats, right? When we say, oh, so-and-so beat on earnings, for example, ADT beats on earnings by 10 cents today. Okay, that those beats, in particular ADT as well, was driven by cost cutting, right? This is a fancy way of saying just eliminating stuff. Look at Tyson the other day. Just get rid of a few things and that'll make our earnings look better. In other words, you would say profit margin management, right? So if you were like a C-suite person and you wanted to use the big words, you would say our cost cutting efforts have really helped us manage our margins in the long term, and therefore we think we'll see a rebound in our earnings through the rest of the year. See, I could do that job. I don't want to do that job. But the point is, that's what's been driving the beats, not actual growth, right? So sales haven't been going up, and I'll explain in UPS in a second. We haven't seen overall volumes going up, which is true for regional airlines. It's true for regional banks. It's true for UPS in this case. So we're seeing that kind of happen there, which, if you want to sort of do this big analysis thing and come to a conclusion, means there's no great reason to be in the stock market right here, per se, and not like overall, but right here. We also know, I shared this with you yesterday, that the S&P tends to struggle a little bit in August in years where it's already positive. So we just got sort of headwind after headwind after headwind, to use that word. And so here you can see the dark blue and the light blue line shows the August intra-month performance when the S&P is positive by two varying metrics, so less than 10% or over 10%. When the S&P is down going into August, well, that's the month to strike historically, and on average, by the way. So that's the the time that you would want to strike. We don't have that right now. We have this going on. We have earnings really from cost cutting. We've got potential slowdowns here that we can see in UPS and other names there. We have defensive movement in the market towards defensive sectors as well as into bonds, which we haven't seen recently. That could also be an indication that we think the Fed may raise rates one more time and then call it quits, maybe pause from there. So all this defensiveness, not to mention I haven't gotten to you guys and your credit card bills. My goodness, I saw that today. Racking up them credit cards, and student loan payments come and redue here. So all of that eats into the economy, and we eventually go, we don't have as much money to buy that fancy truck that's now $150,000 that we used to. We've got bills to pay. We racked up debt, right? The economy is not able to grow as much. So anyways, just wanted to point that out there. It doesn't end there, by the way. Thursday, we have the inflation number coming out. That will be a market moving day, right? So we'll cover it. We'll talk about it as well there. Remember that the inflation number on Thursday should go up, and it's mathematically supposed to go up. It's not that inflation went higher. This is going to be like one of the biggest tricks here we've seen in a while. It's not a trick. It's, it's just we have 12 months to factor in. Okay, we're now bleeding off all that stuff from way back when inflation was high that was making that number look like it was coming down. We'd probably see that number go up, not by much, but if it goes up, that is not a reason to say, oh my God, the Fed losing control, they need to cut rates more. No, they know it too. They're no dummies, so nothing to worry about there. We'll see. It'll be on Thursday though. Anyways, back to bonds here. The 10-year with the rally today puts the 10-year yield, I believe it closed under 4%, which is, it's better than nothing, right? But it's what it is. So that's what's going on over there. I want to talk about oil for a second. Just see the quick rally in oil. We sold off here this morning. Just the pullback of trying to start materializing there. And what happened? Well, we get news that the global oil demand in July was officially the highest ever in history. Ever. Right? So there's this weird shift, like we need the oil, but countries want to move towards being more green. Okay, that's fine, but we need the oil. So demand is as high as we've ever seen for oil. Well, what do you think that's going to do for the price of oil? Obviously, that's helping things out there. So both in the current and in the future, if you follow futures, oil prices rally there, and of course helped out different stocks in the oil energy sector, which started the day lower as well. So a little bit of just bouncing around. I do want to point out Apple here real quick. I was playing around on the research site, and I gotta put it up. I gotta put it up here for you. We're gonna do it. Okay, so Apple, that's now 10% off of highs. It's about 6 days, right? So a 10% pullback in Apple after being strong, I just thought, does it normally bounce? Because I don't recall Apple being something that falls rapidly and then rapidly rallies. It usually stair steps its way up, right? You with me? So I thought we'd check this out. Let me just do this real quick. I'll do Apple falling over 10%. This was 6 days, so we can change that if we like. We'll do, I don't know, 25 years. Let's see what happens, because okay, so here's all the examples of when this has happened. Now we're doing a 6-day window here. Hopefully you can see it there. Over the next 6 days, the average gain is 0.3%, only positive 50% of the time. So that somewhat works with my theory, but I didn't do this part here. Let's get rid of 1 day. We'll say a week. Okay, that works. So let's look at the data going forward, because I'm curious what we find. I didn't do this part. Okay, so what we're showing here on the chart, hopefully you can see it nicely. Over a 1 week period, after it falls 10%, the average gain is minuscule, and it's only positive 54% of the time. Okay, that's fine. There's some outliers in there as well. 1 month, minuscule gain here, and positive just a fraction of a percent better than what it was over 1 week. So what that tells you is this is pretty accurate, actually. So the thoughts of, hey, Apple doesn't just fall and then you need to rush to get into the stock. It tends to take its time, and there's little whippets of back and forth and stuff that'll work out there. In the 3-month window, 6-month window, and 1 year, okay, now over some time after it digests the fact that it had fallen and everybody took their profits and maybe there's some weakness in earnings, it wasn't really a full-on blowout earnings report. Okay, after it takes that time, then it's a worthwhile thing to buy. So that was almost purely off the cuff there, but I wanted to look and see, like, do you need to rush into Apple? No, you don't have to rush. And this is over 25 years. So think about that before you head on over here and say today, oh, I missed the bottom, I got to get in. Probably not. Right? And you can go back through each one of those scenarios to take a look. If you want to take a look, it is jazzwealth.com/research. If you're a client, it's already in your portal, ready to go. If you're not a client, it is $13 a month. All proceeds go to support Drum Corps International, which, by the way, I'll be in Indianapolis on Friday and Saturday this week. If you'd like to come celebrate or hang out with us, be right downtown. I forget that I usually don't say ahead of time, and then I usually run into some of you guys, and it's like, hey, what are you doing here? And I'm like, I forgot to tell you. Sorry. But we'll be downtown. The whole town gets taken over by that. Okay, let's move on. So we've got stocks in the news. UPS, the wild mover here today. So UPS reports earnings, they beat by 5 cents. Now you know, don't just run for that. Whoa, they beat by 5 cents. That's good news. No, let's look a little bit deeper. With UPS, I dug through everything here. Total revenue per package, 1% less than expected. Those are big numbers. 1% is a big number for UPS. So total revenue per package delivered, less than expected. It tells you, okay, we need to look deeper. We'll see what's going on there. Total overall volumes for UPS down 4%. Okay, if the economy was really strong, wouldn't we be buying stuff and just boxes just flying over the country, being dropped off everywhere? Or could it be Amazon has taken over a little bit? You know, it could be, but either way, we need to look deeper. If you look at their domestic ground option, that was the weakest of all of them. The cheapest option was weak. That's not a good sign either historically there. Domestic revenue, in terms of how much revenue they've made here in the U.S. by shipping stuff all over the U.S. and beyond, down 9.9%. That is a very, very poor number for them. For them to hit double digits on loss or down on domestic revenue, you usually find yourself just inside of a recession, if not just before it, historically, right? So then you think they go, well, maybe we'll cut some costs, we'll trim back a little bit. And they said, going forward, we even expect lower volume, higher employee costs, which are due to that deal they just had a couple weeks ago. And so that's going to continue to eat into what we're doing. So what do you have stock-wise? A tiny bit of a reset. There's likely a little bit more coming there. So just wanted to point that out, a little deep dive on UPS. Eli Lilly is the exact opposite. They beat by 13 cents. Stronger margins, raised their guidance going forward. They expect things to continue. Blast-off move that almost held its highs there. I despise this, but I got to talk about it. AMC, they beat by 4 cents. So, is that good? What? Oh, he says, don't pick on my movies. Is that good that they beat by 4 cents? If they made a profit, yes. So they didn't make any money. That's a wash. They operated for the entire quarter and just broke even. So keep that in mind before you get excited and you want to be one of those meme stock people. Lucid, they did probably better than they should there. Missed by 6 cents there. They lost 40 cents in total. The loss was just obviously 6 cents bigger than expected there. And revenues going forward continue to be weak and forecast to be weak by them, not me. We got Under Armour here, so I'll use UAA to talk about this one here. Beat by 4 cents. Now, this is different. They were expected to lose some money. They didn't break even. They actually made a couple cents. Not a lot. They made a little bit. It's not enough to get the stock to rip, roar, and take off there. Nothing's changed with the company. It's just that they were able to cost cut, manage their margins, and therefore they lost, or they actually had turned a profit of 2 cents a share. So, I don't know, it's better than nothing, I guess. One more thing, and then I'll take your questions here, so feel free to put those in the chat, and we'll take off from there. But credit card debt? Well, $1.03 trillion for the first time. So, funny stat for you, every quarter that the Fed raised rates, your credit card debt, the amount of debt you put on a credit card, went up. And that's 7 quarters in a row. So as rates went higher, you thought, well, this is a good idea. I'm going to swipe my card more, and now I'm paying 13%, 15%, 17%. The average is now 20%. And Congress is worried about the Ticketmaster fees that we pay. We must be putting them on our credit cards, I guess. But that's a little bit dangerous. Remember, credit cards, you got to pay the bill, but we have student loan payments coming up, right? So that's going to eat into it. We got higher credit card balances, $1.03 trillion at an average 20% rate. How does anybody have any extra money to then go buy extra stuff to drive the economy forward when we're just paying off credit card debt? You gotta get your dough straight with that one. Credit cards now are, you could kind of make an argument before, like when rates were historically low. You can't. There's no argument for saying a credit card makes sense now. And I don't want to be that financial guru guy that always picks on credit cards, but it's time. It's time, because that is not a fair trade. You swipe a card and you pay 20%. No, don't do that. All right, let's take your questions if you have any questions here. And, of course, I'll be happy to help, see what I can do there. Holiday season going to boost UPS? Oh, sure, yeah. Well, it was, because we'll just use our credit cards, right? We're just going to buy more stuff. Andrew, you got a point there. Breaking even is kind of a win. That's a unique way to look at it. I'll give you that one. They used to lose money quarter after quarter, right? 17 cents loss, 14 cents loss, 20 cents loss. They're like, we broke even. I'll agree with you on that one. As much as I pick on them, that's a win. Yeah. Crazy number of cars in the Lucid plant. Crazy number of cars at CarMax on my way home. I pass a CarMax in Tampa here. And they have so many cars that they're actually filling up the grass area and putting up fencing around it. It's not, I don't even know if it's their property, putting up fencing around it so that those cars are somewhat protected, I guess, until they can sell them. That's how many cars are there. And, they're a public company, so you can look at that a little deeper if you like, which we did when they reported their earnings. Stop loss at 7 on Under Armour. Oh, okay. Wide stop loss. Go. Ticketmaster ruined live music. Oh, I said the bad word, right? They ruined live music. Shasta, yes, taking new clients, so you can join us, and thank you for thinking of us, but we're jazzwealth.com. You want to, so Tom's back to looking to India there. I saw the JP Morgan, not JP Morgan, I saw the Bank of America report on them. Remember, a lot of people are moving and shifting production of, because of what's happening in Taiwan or potentially happening in Taiwan. A lot of people are being proactive about that. That's the reason why I have a lot of excitement there, so I don't blame you. What's your take on the new PayPal stablecoin about the stock holding 62? So I don't get to decide on the stablecoin. Binance, maybe? If you follow that, you can correct me on this one. But this was attempted already and partially shut down. Now they got around it, but I don't know that that's something that they'll let continue. I don't get to make the decision, of course, just like the Bitcoin ETFs with ARK and iShares and everybody. It's just not up to me. So I applaud them for the effort in trying to stay relevant, but I don't get to decide. Yeah. Is $1 trillion in credit card debt good for PayPal? Boy, they need a boost. Not like you would think is good for. And so the reason I'm going to say that it's good before I, make somebody mad, I'm about to say that something is good for MasterCard and Visa and Discover and Capital One, but it's good for them, right? The reason it's good for them still is, how do we tell? Delinquencies. The number of people that are 30 days past due, but not more than 60 days past due, still historic lows, meaning you're still paying the interest and you have the money to do it. The number of transitions from 30 days to 60, we'll do that tomorrow. From 30 days to 60 days, the transition to now being 90 days delinquent, still historic lows. So people are not getting further and further in debt. That's what everybody watches in this space. So the $1 trillion is a headline number, it's exciting and everything, but if we're paying it, okay, people have chosen to pay those higher rates. When there's delinquencies start rising, that's the problem you want to look at there. Yeah. Yeah. I like it. I didn't catch Celsius earnings. Is that after hours? Actually, tomorrow, by the way, you have Office Depot, still a thing. Penn National, Roblox, Wendy's is one of the worst performers, actually. Disney will come up after hours. That'll get a little attention. I'm sure Bob Iger will be on the financial news media. Wynn Resorts, and that's pretty much it after hours. Disney and Wynn Resorts will be the main focus after hours. And Disney's had a little bit of a checkered past here performance-wise. Only up 3 of the last 8 quarters. So this is their chance. Come on. They can do it. I kind of have faith in you. All right, I'll wrap it up there. Wish you guys a good rest of your day or evening. Thanks for following us. Thanks for keeping us in mind, and we will see you again tomorrow. Adios.